Let's back this up, and I'll point to valuations, where the bond market is, and what is being expected for earnings growth. The PE ratio on the S&P 500 is close to 15 times after this damage. Analysts are expecting earnings to grow at 9%, and the 10-year bond yield is just above 3%. Let's keep these three in mind. Let's assume for a moment that the bond market is right about where yield should be. That means today's valuation is actually implying a 0% earnings growth rate for next year and the year beyond. That's how the arithmetic works out. If the analysts are right, then it means that the 10-year bond should be 50 to 75 basis points higher than where it is today. Those are very dramatic outcomes. And we don't believe the implied growth outcome from today's valuations or interest rate assumptions are likely to materialize. Look, things are slowing down. It's almost interesting because it should have caught nobody by surprise. Everybody knew growth would taper down. The market's violent reaction is suggesting a far more dire consequence. We see growth slowing down, GDP growth down.
Just slowing, not cratering.
Correct. So your options, your menu of choices are, will we have a modest tapering of economic and earnings growth? Will we have a sharp slowdown or an outright recession?
You're in camp number one.
Camp number one, GDP slows down to 2%.
Let me bring in Hugh Johnson to get his reaction to what Sandip just said. Do you see it that way, even in light of what we began with by saying that your bullish resolve is getting a little wobbly?
Well, your bullish resolve has to get a little bit wobbly when you see the markets decline and when you see the internals in the market, sector performance turn on the bearish side, and you see the capitalization performance, same thing. I actually like what Sandip have to say. I watched or listened very carefully as he walked us through the valuation argument, and I think that's kind of the silver lining behind this really dark cloud. I think it is the case, if you put all the numbers together, that we've gotten to a level that's undervalued. Even assuming, and everybody seems to know this, that we're going to have a slowdown in the growth rate of the economy from 2.9 to roughly 2.5, 2.6 in 2019, and we're going to have a slowdown in the growth rate of earnings from roughly the 22% level down to, say, the 8 or 9% level. Put all those numbers together, Sandip is really right on. It still means that we're going to have an ongoing bull market, and what this, again, the silver lining is, in my judgment, and his judgment, is that we've gotten to a level that's undervalued or represents a buying opportunity. And I think that's really where we are right now.
All right, Sandip, let's go through you make a very clear case for why we should see higher stock market values. What exactly then is happening right now? What in your mind is taking place? Is it a simple revaluation of growth parts of the market? And if so, how much deeper could it go before that constructive move back to the upside?
So the biggest driver behind the sell-off is the repricing of stocks to lower growth expectations in 2019. A couple of other things happened along the way. This all started when the 10-year bond yield broke through 3% in early October. Then we had greater uncertainty on the fronts of trade, tariff, Brexit, Italy. But the biggest driver is growth, and this is what it really comes down to. If we end up with a recession in the next year or two, there is more downside and a likely bear market. If we don't see it, we'll end up with a correction. And this 2650 level on the S&P 500, if we end here, this will be a triple bottom. That might be the end of it before we resume growth.
So, Hugh, we're watching the Dow approach its previous session lows, right now down by 540 points. 2018, Hugh, is basically a do-over now at this point. I mean, we've erased all of our gains, and we're actually in the red for all three major indices. So with this backdrop, what do you and your bullish resolve invest in?
Well, the first thing is I think that, you have to be responsive in this business to trends that are going on in the markets. In other words, you simply can't ignore them, even though you might think this is a buying opportunity, or you might think the market's undervalued, or you might think it's only a correction in an ongoing bull market. That means it certainly, when we've now hit the 117-month mark of this bull market, obviously, that's the longest bull market in history. It makes some sense. It's certainly rational to take some money off the table. In other words, to reduce your exposure to equities. And if you do own equities, which most of us do own, you might shift a little bit from the so-called economically sensitive the bull market sectors of the market into the bear market sectors of the market, or the bull market, bear market sectors. So take a look at consumer staples. Take a look at healthcare. They're performing well now. So you look at companies like CVS. You look at companies like Walmart, which offer pretty good dividends and also offer some really good relative performance. So I'm saying maybe reduce your equity exposure some and also shift within your portfolio, shift to the more, let's call it defensive equities. Again, given the fact that you got to be responsive in this business to trends that are undergoing in the market.